This is Chapter 2, An Introduction to the Conceptual Framework. The first thing that we've got to talk about when we talk about a conceptual framework is what is the conceptual framework and why do we need it? When we say conceptual framework, we mean a theoretical underpinning of why we do accounting the way we do accounting. The goal of accounting information is to make information that's useful to decision makers. So we've got to decide what makes information useful to decision makers. Without this big picture, we may make accounting rules that aren't useful to decision makers. They may not be consistent over time if we're not referring back to the same set of principles, and they may differ across different topics. In addition, the conceptual framework helps standard setters to respond quickly when new accounting issues arise. So let's say that there's a new issue that arrives due to pay-per-click advertising. Well, we have a conceptual framework that tells us this is how we account for revenue, and so that gives us a basis for how to account for pay-per-click revenue, for example. This project was developed by the FASB and they started working on it in 1976. The result of this project are 7 statements of financial accounting concepts. The IASB and the FASB began to work on a joint framework but have since abandoned the project. We're just not quite there yet. When we talk about the conceptual framework, there are 3 basic levels that we talk about. The first level is the why, the objective of financial reporting. Why are we doing what we're doing? The second is the what. What tools do we use to do that? When we say the what, we're talking about specifically what are things that make financial information decision useful, and what do we present to provide that information? So that would be the elements of the financial statements, i.e. assets, liabilities, equity, etc. The third level is the how. How do we do this? So this is recognition, measurement, and disclosure, and we will touch on those topics a little later in the lecture. So let's start out with the what. The first thing we've got to talk about is the different elements of financial statements. So we'll start with assets. Assets equal liabilities plus equity. That's the fundamental accounting equation, and that's kind of what we're going through today. So when we define an asset, it's a little different than you might define an asset, like a personal asset. You may think an asset is something that is beneficial to you, and that's part of the definition of an asset, but the accounting definition of an asset is a little more specific. This is an important definition that you're really going to want to spend some time learning. You need to know this for the exam, and it's just a good thing to be familiar with for your career going forward. An asset is a probable future economic benefit obtained or controlled by a company as a result of past transactions. That's 3 sections. The first thing, an asset is a probable future economic benefit. The second thing is that it's an obtained or controlled by a company. And the third thing is that it's a result of past transaction. If an item doesn't meet all 3 components of that definition, it is not considered an asset from an accounting perspective. With assets, they appear on the balance sheet. That's the financial statement that they show up on, and they are a permanent account. Some of you guys may not remember permanent versus temporary accounts, but basically permanent accounts are not closed out at the end of the year or the accounting cycle, and temporary accounts are. Another name for temporary accounts is nominal accounts. So an asset is a permanent account, and an example would be cash. Does cash get closed out at the end of the year? Well, hopefully not. Hopefully your cash carries on into the next year, as opposed to something like income, which we'll talk about a little bit later, which would be a temporary account. Another good thing to remember with assets is that debits increase an asset and credits decrease an asset. So when you're doing a journal entry, if you're trying to increase an asset, you need to put that in the debit position. If you're trying to decrease an asset, you need to put that in the credit position. Next, we'll talk about liabilities. So liabilities, the definition is kind of similar to an asset. It's a probable future economic sacrifice of a benefit. So instead of a benefit coming to you in the future, you're planning to give up a benefit in the future. And then the rest of the definition is the same. Second part, obtained or controlled by a company. Third part, as a result of past transactions. Like assets, liabilities show up on the balance sheet and they're a permanent account, meaning they don't get closed out or zeroed out at the end of the accounting cycle. They roll forward from period to period. So if you think about a loan or a bond payable, your liabilities don't go away just because the accounting cycle ended. You still owe that money, or you still owe that customer that service, whatever. You still have that liability the next year, and so liabilities do not zero out at the end of the accounting cycle. They're a permanent account. And as a refresher, debits decrease liability and credits increase liabilities. So you'll need to remember that when you're doing journal entries going forward. The next element of the financial statements we'll talk about is equity. Equity is a little more abstract. Equity is what is left over after liabilities are deducted from assets. It's a residual amount, so it's also known as residual interest. So if you take and add up all the assets that a company has, you subtract out all the liabilities, equity is what's left over. And this relationship gives rise to the fundamental accounting equation that we talk about. Assets equal liabilities plus equity. Equity appears on the balance sheet and is also a permanent account. Like liabilities, debits decrease equity and credits increase equity. But equity is a little more, as I said earlier, abstract. It's a little more complicated to think about than assets or liabilities. And so the next slide breaks it down for you a bit. Equity is primarily composed of stock and retained earnings. So stock is paid in capital to the company. Retained earnings is capital that has been generated by the company's previous income. Retained earnings is basically a holding tank for all of the net income that the company has ever earned, and it's reduced by all the dividends the company has ever paid out. Now, income, net income, is equal to revenues minus expenses. So, this is sort of a preview for Chapter 3. In a given period, a company incurs revenues and expenses. Those are closed to the income summary, which are closed to retained earnings. And retained earnings is sort of the permanent long-term holding tank for all the income the company has ever generated. And so that's an important concept of understanding what equity is really composed of. And this is something we'll refer back to periodically over the course of the semester. Now that we've gone through the basic definitions of the elements of the financial statements, let's do some practice identifying these elements. This is similar to it is an adaptation of the chart that you have in your notes, so that we're going to go through these assets or possible assets one by one. Starting with cash. Well, hopefully you just know off the top of your head that from your intro class that cash is in fact considered an asset. And let's talk about why. Does it meet the definition of an asset? Does it have a probable future economic benefit? Yes. Is it obtained or controlled by the company? Yes. And is it a result of a previous transaction? Yes. Those are the things you've got to think through when you decide whether or not these are assets. Equipment, very similar. Do you have a probable future economic benefit from a piece of equipment? Well, yes, it's probably making whatever you produce. So yes meets the first part. You bought it. That meets the third part, the result of the transaction, and it's obtained or controlled by your company. So yes, equipment is considered an asset. Now, a customer promises to pay for services. Let's think about this. Is that a probable future economic benefit? Well, yes, they're promising to pay in the future. That's a future economic benefit. Is that obtained or controlled by the company? Yes, you provided that service, so you've obtained that promise. And is it a result of a past transaction? Yes, you provided a service. So this is an asset, and in fact, this asset is, drumroll please, accounts receivable. This is just the definition of accounts receivable. Now, let's change this a little bit. Let's say a customer promises to pay for services that they can't afford, and we know they can't afford it. Does this meet the definition of the asset now? Is it a probable future economic benefit? That's where the hang-up is. Economic benefit? Sure, but is it a probable future economic benefit? The answer to that is no, and so we cannot consider that an asset. It's not a probable future economic benefit. So this would be probably recorded directly as bad debt. Or in the case of, say, a hospital, this would be recorded as uncompensated or charitable care. Those are some scenarios where something like this would happen. A leased building. So a lease is like a rent, is rental. So if we go and we lease a building, that means someone else owns it and we are paying rent for it. This gets a little bit complicated because there are actually two different kinds of leases, capital and operating leases. This is something you'll cover in Accounting 328, so I'm not expecting you to differentiate between the two on, say, an exam, but I do want to introduce you to this concept. So let's talk about two different rental scenarios. In the scenario one, you are renting an office building, and let's say it's a 2-year rental. So you're paying $5,000 a month for a 2-year rental. In that case, in the grand scheme of things, 2 years is not a big chunk of that office building's life. It's just a plain Jane rental situation. We call that an operating lease. Let's take another example though. Let's say that you are renting a piece of equipment, a tractor, and you are renting that tractor for 10 years. The useful life of the tractor is 12 years. So in that situation, you're basically renting that tractor for the entirety of its life. That's a little bit different. And so from an accounting perspective, we might account for that using what's called a capital lease. And capital leases are actually, we record an asset and an associated liability for those capital leases because it's essentially buying a tractor under another name. Again, I don't expect you to be able to differentiate those two on your own. I'm just introducing the concept here. So the answer to that is maybe. It depends on whether the lease is a capital lease or not. If it's a capital lease, then it does provide a future economic benefit because you have it for a long period of time. It's a result of a past transaction, and it's obtained or controlled by the company. That's key there, is a capital lease versus an operating lease has an element of control by the company. Again, you don't have to know that in and of itself yet, not till you take 328. Raw materials. So raw materials are a part of a company's inventory. Do they meet the definition of an asset? Yes. Probable future economic benefit, you purchase them, and so it does meet the definition of an asset. It's part of inventory. All right, moving on to a few more assets. An investment a company made in common stock of Walmart. So let's say that a company has some extra cash laying around that they won't need for another year, hypothetically. Well, it doesn't make a lot of sense for that cash to just sit there. If they can invest it, they can make some money on that cash. And so companies often do that when they have excess cash. Now, if a company does that and makes this investment, does this meet the definition of an asset? Does it provide a future economic benefit? I would say yes to that, right? You're expecting, if you make the investment, you are expecting that you're going to make money on it. Of course, it's probable, not certain, right? It doesn't have to be a certain future economic benefit, but it's a probable future economic benefit, and it was a result of a past transaction, and it is controlled by the company. So, yes, that is what we call an investment, and we do an entire chapter on investment assets in Chapter 17. Prepaid expenses. So a prepaid expense, let's say you prepay your rent, for example. Does that provide a future economic benefit? Yeah, you've already paid for your rent, so that's a future economic benefit, etc., etc. Yes, that would be considered an asset. Really smart employees. Now this one's a little bit tricky. In the layman's definition of an asset, you might say that this is an asset because it is a benefit to your company, but does it meet the accounting definition of an asset? Could you capitalize really smart employees on your balance sheet? And hopefully common sense would tell you that the answer to that is no, right? But let's talk about why the answer is no. Employees do provide a probable future economic benefit, yes. But are they obtained or controlled by the company? Well, I hope not, because that is illegal. And did you purchase them in a transaction? You had better not have purchased your employees in a transaction. So, no, it does not meet the definition of an asset. Employees are not controlled by the company or a result of a past transaction. Loan payable. So you owe money and you need to pay a loan. Is this an asset? Hopefully, the word payable gives you a hint. No, this is a liability. This is a probable future sacrifice of a benefit. So this meets the definition of a liability, but not of an asset. A patent on a product we manufacture. So This is protection for the design of that product. Does that provide us a future economic benefit? Yes, we have protection over our future moneymaker. And then this is a result of a past transaction. Patents cost money to obtain, and it's controlled by the company. So yes. And then treasury stock. This may be a little bit fuzzy to you. You may not remember this. Treasury stock is essentially a company's own stock that it has bought back. So it issued it at some point, it was out on the market, and then the company, for whatever reason, decided to buy it back. It is buying stock, so in that sense, it's similar to the first investment we see on this slide, but it's not an external investment outside of the company. And so in that sense, it's not providing a future economic benefit. It's essentially unissuing stock. And so you can't, so that's not a future economic benefit. Although it may have beneficial effects, it's not providing a future economic benefit in the way that an investment or inventory would. So treasury stock is not considered an asset. It's a part of equity. It's a contra equity account. Okay, so we've talked about assets. Let's move on to talk about liabilities. The first one, income taxes payable. Just a hint, anytime you see payable on an item, it's probably going to be a liability. So we owe taxes, we will have to pay those. That is a future sacrifice of a benefit, and it is obtained or controlled by the company. We incurred that by earning income as a result of all those past transactions. So yes, income taxes payable is a liability. Unearned revenue. If you don't remember what unearned revenue is, here's a refresher. Let's say that we provide a service for a customer and they say, I will pay you later. That's accounts receivable. Unearned revenue is kind of the opposite. Unearned revenue is when a customer provides cash to us, pays us cash, and we provide the service at a later date. So an example would be like an airplane ticket. You pay for an airplane ticket months in advance, but you actually incur that service later. So from the airline's perspective, that payment of that airline ticket is unearned revenue. So let's think about, do we have any kind of liability here? Do we have a probable future sacrifice of a benefit? Well, yeah, we've got to provide that service. Is it a result of a past transaction that's controlled or obtained by our company? Yes. So unearned revenue is a liability. Restricted cash. If you're not familiar with this one, restricted cash is basically cash that's set aside for a certain purpose. So this can be a little bit tricky because sometimes this purpose involves a liability. Let's say that we're going to build a building. Well, you might think, well, this money is set aside to build a building in the future, so maybe I owe money on that building, so it's a liability. No, that's not good logic. Restricted cash is just plain old cash that's set aside for a certain purpose. And what do we know? We've already decided that cash is an asset. So restricted cash is an asset, not a liability. Long-term debt, this would be something like a bond. Hopefully right off the top of your head, you can say that yes, this is a liability. We've got to pay that off later, so we have a sacrifice of a benefit coming. Depreciation expense. This one could be a little bit tricky. Depreciation expense is an expense. Based on the slide we saw a few slides ago, expenses are part of what? They are part of equity. Expenses roll up into income, which rolls into retained earnings, which is a part of equity. So depreciation expense is incurred in the current period, not a future sacrifice of a benefit, and it's part of equity and retained earnings instead. Last one, pending litigation from a customer who is suing the company. So let's say you're being sued for something. The answer to this one is it depends. If you're being sued for something that it depends on the likelihood of the lawsuit being won or not. So let's say that you are McDonald's and someone spills really hot coffee on themselves and sues. Well, this has actually happened and the person actually won because McDonald's coffee was just too hot, apparently. So that would be a case where, yeah, that we know from previous precedent that if this happens, that the likelihood is that we will actually not win that suit and we'll have to pay out. In that case, we do have a probable future sacrifice of a benefit, so we should record a liability. However, let's say someone stubs their toe in McDonald's and sues us because they stubbed their toe. Well, unless we have some kind of hazard in the way or something like that, it's not likely that that person is going to win that suit. And in that case, because it's not probable, it's not considered a liability. So that's something you'll discuss in more detail in 328, but yeah, that's good to think about now. Okay, so we've kind of talked about the what in terms of what financial statement elements we're talking about. These definitions are going to be really important. We're going to refer back to them over the course of the semester, so make sure you're familiar with this going forward. The next thing we're going to talk about is what are some desirable characteristics of accounting information. When we say decision useful information, what makes that happen? Well, it's information that investors and creditors can use to make decisions about whether or not to invest in a company. And so what you see here in this chart, decision usefulness is sort of the overarching goal here. There are some fundamental qualities, two fundamental qualities that make information decision useful: relevance and faithful representation. And that's what you see at the top in the orange right there. Those are the two primary fundamental qualities of accounting information. We want it to be relevant to financial statement users, so that means capable of making a difference, and that's what you see in your note. It's capable of making a difference to investors. Some ingredients of relevance would be predictive value. It allows you to predict what's going to happen in the future. So an example of that would be comparative financial statements, where you see, okay, this happened, revenues were this amount in 2015, this amount in 2016, and this amount in 2017, so I can extrapolate that in 2018 it will be X. Confirmatory value, that's sort of the flip side. It can confirm previous expectations. So I thought 2018 income was going to be this based on previous years, and in fact it is, and in fact it's not. Maybe I don't want to invest in this company. Another ingredient would be materiality. So materiality means how big of a deal is it? If let's say that we have a small decrease in income over the course of a few years, well, that's probably not material, a couple $100 or $100,000, depending on what our scope is of our income or our number that we're talking about. However, if there's a very large or dramatic change in a certain number, that would be considered material, and that would be relevant to investors. So materiality can be qualitative, it can be quantitative. Auditors have specific materiality thresholds that they use to decide whether something is quote-unquote material or a big enough deal. But generally speaking, it's ultimately going to be a qualitative thing. Is this change, or is this error, or is this whatever big enough to make a difference to investors? So those are the three ingredients of relevance. Then there are three ingredients of faithful representation: completeness, neutrality, and being error-free. So completeness is all the information I need to make a decision there? Does it have everything that I need? Neutrality would be, does it favor one party over the other? Does it favor, does it maybe make us look a little more favorable, make the company look a little more favorable than it should? Does it provide information to one investor over another, or creditors over investors? It needs to be neutral and not favor any particular party. And then, of course, a huge part of faithful representation is that it is error-free. So you don't have any errors in your financial statements that would be misleading to investors. Of course, these things are going to work against each other sometimes. So in audits all the time, auditors find errors in companies' financial statements, but they're not fixed. Why are they not fixed? Because of materiality. It's not a big enough deal to make a difference to financial statement users. So sometimes these different qualities can actually a little bit be in conflict with each other. And that's why we've got to have this framework to have an understanding of what's most important in this situation or what's most important in this situation. So our two fundamental qualities of decision usefulness are relevance and faithful representation. But there are some other good qualities as well. So that's what we see down below, the secondary qualities: comparability, consistency, verifiability, timeliness, understandability, and conservatism. Comparability is comparing across two companies. So if you're looking at Phillips 66 and Exxon, you want to be able to compare those two companies. So you want those financial statements to be prepared using similar rules so that you know that you're comparing apples to apples. Consistency has to do with information for the same company over time. So if you use LIFO for inventory one year, you need to use LIFO for the next year to make your financial statements consistent over time so investors can use that information. Verifiability has to do with the fact or the issue of, can this information be verified from an external source? So if I tried to arrive, let's say that I have pending litigation, I might have a liability. I've got to guess at how much that liability might be. So I might get two different quotes or estimates from my legal counsel about how much this quote could be, and I can verify that from two different sources. This legal firm says this legal firm says this, and they're pretty similar. So we have a good idea that the amount of the lawsuit will be X. That would be an example of verifiable information. Timeliness is critical. Timeliness is the information made available in time to affect an investor's decision. So if a company releases information about something that happened in 2015 income right now, and I'm an investor, do I care that much what happened in 2015? I mean, a little bit, but it's not going to have a huge bearing on my decision right now in 2018. Whereas information from last December is still going to be pretty timely now as I'm making my decisions, or information from, the second quarter of this year, though that's timely information. Or let's say that you have a natural disaster. Well, providing investors with timely information about that natural disaster in your 10Q in your quarterly financial statement would be an example of providing timely information. Understandability is also key. It's important to know here that understandability doesn't mean that average Joe off the street could read your financial statements and know what's going on. It's assuming that someone who's had some financial training, i.e. someone that has taken this class, basically, could understand what you're saying. It's got to be understandable enough that someone with reasonable financial knowledge could understand what you're trying to say. And then conservatism. This one's key. We'll refer back to conservatism very frequently throughout the semester. I kind of think of conservatism as being the wet blanket. You want to err on the side of being conservative, of not overstating assets or income. So if you have a choice, you can account for something with this assumption A, or assumption B. But assumption A leads you to have a higher asset value. Well, you should use assumption B because you don't want to overpromise. I always think about under-promise and over-deliver. That's what you're talking about with conservatism. You want to do something that's not going to overstate assets or income. Because you don't want to set false expectations for investors. Or I shouldn't even say false as much as unrealistic expectations for investors. Okay, so we talked about the what. We defined the elements of the financial statements. We talked about key characteristics that we're looking for in good financial information. The last thing we've got to talk about is the how. So the how, we're talking about recognition, measurement, and disclosure. Recognition means, when do we recognize an asset? At what point is an asset an asset? That's something we've got to think about. Measurement is, we say, okay, we've decided this is an asset, but now we have to assign a dollar value to that. How do we measure the value of this asset? And sometimes that's easier than others. And then disclosure is, what kind of information do we need to give investors about this asset or about this process so that they can make an educated decision about our company. And those are some things we're going to talk about. We're going to talk about recognizing and measuring and disclosing lots of different topics, lots of different financial statement items like inventory or investments over the course of the semester. A fundamental issue we've got to talk about before we do that, though, is some accounting assumptions. So these are some key underlying accounting assumptions we've got to make before we can move forward. One is the economic entity assumption. So a company's business is considered separate from owners, managers, or other business units. It's its own thing. It's not necessarily the same as a legal entity. You can have several legal entities that are one economic entity, probably vice versa. but you've got to think the business is separate from the owners. The second one is going concern. You're assuming that the company will have a long life. You're assuming it's not going out of business tomorrow. This one's very important for things like depreciation. If you recall, depreciation is splitting up the cost of an asset over time. If you don't expect the company to last that long, why would you depreciate over that amount of time? So if you expect the company to go out of business in 3 months, depreciating over 3 years makes absolutely no sense. Same as current and non-current classifications for assets. Current versus non-current, that's current assets are going to be used up within a year, non-current are beyond that, but if you only expect to operate for 6 months, why does that matter? So going concern is essential for doing things like depreciation and classification over time. The third assumption is the monetary unit assumption. We're assuming that money is the best way to express information to interested parties. That's why financial statements are in dollars. We usually don't consider inflation, especially in the US, because inflation's not big enough to make a material difference. This is where we go back to that conceptual framework, those fundamental characteristics. And then periodicity. That's a long word, kind of hard to say when you're getting used to, but periodicity just means that a company's activities can be divided into artificial time periods that are meaningful. So if I want to give you the history of Exxon. Well, Exxon's probably been around, I don't even know, let's just say 100 years, right? So if I give you all the revenues and expenses for Exxon for the past 100 years, it's not really that meaningful to you. You want to know what's going on right now. And so dividing up revenues and expenses and things like that into artificial time periods, monthly, quarterly, annually, etc., provides better information about what's going on right now. So that's what we do in accounting is we divide up those financial statements into those periods. Now there's a trade-off. A shorter time period means more errors. There's not as much time to check it. So you can't provide financial statements every day. That's not realistic. You can't check those, right? They're not going to be error-free if you do that. But you want to do it often enough. You want your periods to be short enough to provide good information to investors. Now, that's where we're going to leave off for today. We will finish talking about the rest of the how in class on Monday.